Welcome to my very first YouTube video. I'm very excited. Hopefully this will be the first of many videos, and thank you very much for watching. I am certainly honored and appreciative that anybody would watch any of these videos or listen to anything I have to say. And most importantly, if you have any questions, you can always reach out to me at CryptoQF. That's my Twitter handle. I always like to have conversations with like-minded people, so feel free to shoot me a DM or anything like that. So this video is going to be an introduction to my quantitative coin selection model, and I'm going to talk about how it works, why it works, how I use it, and its performance. Back-tested performance is excellent, so we're going to go over some of that and how to interpret that. And most of all, I just want to emphasize that obviously none of this is financial advice or anything like that. I'm just showing you guys how I use the model, and you can take that for what it's worth. And I'll certainly show you guys, I think, the best practices in terms of using the model. And I'd love to share the information with you guys because I consider all of you my friends in some way, shape, or form. So I'd love to just jump right into it. But I think most importantly here, to have to give a little bit of a backdrop on what exactly is quantitative analysis. So I can't just pull up a spreadsheet and just start saying these are the best coins and these are the worst coins. I think I have to kind of lay the stage a little bit. So I'm going to do a little bit of a history lesson of investment management and different styles of investing. And hopefully this kind of helps you understand what the model is trying to do and what foundation it's built off of. So most of you are probably pretty familiar with technical analysis. That's really what most people that invest in trade in crypto actually do. If you look on crypto Twitter, that's 99% of people are doing some sort of TA. But then you also have FA, fundamental analysis. That's pretty darn hard right now in crypto, but some people still try. I'm not sure exactly, where that's going to go in the near term. However, in the long term, certainly fundamental analysis is going to be pretty dominant in crypto. Quantitative analysis is basically non-existent in crypto because we just simply didn't have the data. Now we're actually getting the data, enough backdated history, and enough coins to actually start building some great models. But what about history? So that's a kind of wind back time about 100 years ago. And at that point in time, there was no fundamental analysis. There was no quantitative analysis. Why? Well, quantitative analysis, simply, there was obviously no data, no computational power, nothing. So that wasn't even remotely on the table. Fundamental analysis back then, well, you barely even knew what companies did, let alone what their earnings were, let alone what their competitive position was, let alone what their debt levels were, or anything like that. So it was very, very difficult to do fundamental analysis back then. But what you did have was price action. With price action, even 100 years ago, people could take out some graph paper and just graph it out. And you have a nice, pretty chart. Now, obviously, 100 years ago, you didn't have all the indicators that you guys use currently, but you certainly were able to have some nice charts. And that worked pretty well for quite a while, and there was a lot of advancements when it came to TA. But rewind about a handful of years later, and fundamental analysis began to step up. And a couple guys named Graham and Dodd, really the founders of fundamental analysis. What they did there was they introduced most people to value investing, basically saying you want to buy companies that are trading or have prices that are lower than what their earnings would reflect. Or perhaps you want to buy companies that are higher quality or have great competitive positions or wide moats, various things like that. And fundamental analysis continued to grow and grow. And it took a lot of what I call it market share away from technical analysis for quite some time. And a lot of investment managers were actually using fundamental analysis at that point in time. Even still, and this is, we're talking 50s or so, quantitative analysis didn't really exist. Again, we had no computational power or anything like that. Nothing in terms of databases. So it was very difficult to do any sort of mass statistical analysis. However, they started Moving forward in terms of some quantitative portfolio management skills, you had a guy named Harry Markowitz who won a Nobel Prize for modern portfolio theory, basically talking about the optimal way to combine assets into a portfolio. A guy named Bill Sharp also won a Nobel Prize. Then you had people like Bill Haugen, Fama French. That's two guys, Fama and French. Really started developing multi-factor models, which is what I've built here and I'm going to share with you guys. So with those guys, Haugen, Fama, French, what they were primarily trying to do is figure out what is actually driving stock returns. Can we actually use history and data in some ways predict what characteristics or factors are going to lead to potential outperformance in the future? So even though I mentioned somebody like Graham and Dodd was the founders of value investing, and they certainly were, but up until somebody like Fama and French, nobody really knew what that value meant in terms of excess returns in the future. So if a company was cheaper than another company, well, what does that mean? Does that mean they're expected to outperform, and by how much? Okay, that's great too. But now let's throw in other things like they were a smaller company or they had similar risk profiles. Does that cheapness still matter? And when you begin to put a lot of things together, you start building a pretty robust, quantitative model. And that's what I like to emphasize too, is quant is not something that's totally different than FA or TA. What it's really doing is taking the components of FA and TA and marrying them through a statistical process. So, I mentioned value, where Fama and French, put it in a quantitative model. But what about something like momentum? Obviously, people were doing technical analysis, trend following momentum for a while. I mean, you had the turtle traders. It's obviously a pretty big part of TA. But one of the big advances in quantitative analysis was the discovery of momentum. There's a guy named Carhart that did that. And most famous and most potent form of momentum for stocks is what they call 12 minus 1. So 12 months minus 1 month returns. It's really an 11-month window. And this happened way, way, way after technical analysis even thought about trend. But the advance really was being able to say, look at every company out there that 11-month return, that 12 minus 1, and say, okay, well, that's great. But what does this mean for the future? What's our expectation that a company that had a certain 11-month return is going to perform what over the next month or next 2 months, 3 months, 1 week, whatever it might be. So that was a tremendous advance. But even more importantly, I think an issue with TA is you might have a lot of information. This is where quants can kind of filter it out. So for example, two basic trend type analysis. Let's just say, and this is actually what I use in this coin selection model, so it's pretty pertinent. Let's say a coin had a great 1 week or 2 week return. It's been doing fantastic, tremendous momentum. But it dumped yesterday. What does that mean? Right? I mean, that's just two things that might be contradictory. You can throw a million other things in there, but what does that mean? Well, a quant, and I'm actually going to go through some R code, not this video, but going to build a quantitative model and see how this works. But you take those two indicators and run it through a model and say, wow, okay, well, clearly a coin that dumped yesterday has tremendous opportunity for growth. There's a reversal effect. And a coin that did well the past 2 weeks also is supposed to do well. So you combine that. Those are two great characteristics to have that maybe TA wouldn't pick up. But let's even take the flip of that and say it did great for the past 2 weeks and it pumped yesterday, had a great return. Well, how do you marry the fact that a 2 week return is a great sign, but a pump yesterday is a bad sign? And that's where quantitative analysis can kind of have that seesaw effect. Which one's more dominant, depending on how big the 2 week return was or how big the pump was yesterday. The quantitative analysis is able to put it all together. And that's just two factors. I mean, you could throw in volatility factors, volume factors, whatever it is. the model I'm actually using has 16 factors. So it's kind of putting all those characteristics to a pot of chili and coming up with the the best tasting that it can come up with, really. So it's I'm pretty excited, basically. So anyway, so quantitative analysis, now you have a multi-factor model, momentum is part of it. And now you have big data. So we're able to filter through thousands of companies' characteristics, that which equals millions. So this quantitative model that I built for crypto, I have basically millions of lines of code. So it's pretty robust, 16 factors. It's looking through quite a bit of things, and I'm excited to show you, what I did and how I did it. So I'm going to hop over to some Google Docs and kind of walk you guys through it. All right, guys. So if you've been following me on Twitter, you've been noticing I've been sharing some Google Docs of the resulting model every day. So I just wanted to, mention one more thing here before we kind of dived into the model. Is what's really important here is this model is looking at it from a portfolio or strategy level. It is not, I emphasize, definitely not saying just buy one coin or sell one coin that looks favorable or unfavorable. Here, I'm a big believer, and I actually tweeted this out today, that you have to look at your investments holistically from a portfolio standpoint, not from like a one stock or one coin signal perspective. It's actually called the prudent investor rule. So here, to emphasize what this model is actually trying to do, this assumes that you're long only. Now, it doesn't mean your entire crypto portfolio is long only, just whatever portion is long only. So maybe 10%, 20%, 50, 100%, doesn't really matter. But whatever portion is long only, this is saying, well, this is a very good or optimal way to manage your coins within that long only bucket. So what about the goal of a long only bucket here? So what this model is trying to do is really have two major goals. One is to create a portfolio of coins that beats the average coin. So you basically grow your account value greater than what you would if you invested in the average coin or all the coins. And then secondly, it's to outperform the worst coins, so the best versus worst. But either way, it's from a holistic standpoint. Anything can happen with any particular coin, any particular day. So that's the danger of just investing in one thing and letting it ride. So no matter what anybody says, just buying one coin because it's supposed to pump or it looks great, that's total BS. So we certainly want to diversify a little bit and have a holistic portfolio approach. So how'd I build this? So I mentioned 16 different factors. These factors range from, like I mentioned before, you have something like simple as 1 day return, or performance over the past week or two, drawdowns, volatility, as in how much the price for coin is fluctuating, to volume factors, kind of goes on, but there's 16 altogether. So what is really a quantitative model? So I mentioned a lot of history, and that's great, but haven't really dove into what exactly am I doing? So, and how do I come up with a million lines of code? So what's happening is, let's just take yesterday when I ran this a few hours ago. So I have here 200 some odd coins. Now I slim it down due to volume and certain characteristics, but I start with basically every coin in existence. And I'm looking at, there are 16 factors that I identified right now. So what's the 1 day return for every coin? What's say the 1 week return for every coin? What's the volatility for every coin? What's the volume for every coin? Now, some of those factors I'm simplifying a bit, but I get that for all coins. In this case, say 200 after the volume constraint. So I have that. And then what I'm doing is I'm basically running a pretty simple regression, doing some fancy regression weighting and things like that. Nothing that you necessarily need to know. And I'm also, cleaning up some of the data. Anyone's interested in some of the detailed statistical work, feel free to shoot me a DM. But we don't need to jump into that now. But so I have all these characteristics of all these coins, and I'm regressing them against the next day's return. So do these characteristics that these coins have today influence or correlate to the return tomorrow? And basically I found out, yeah, they do. But the reality is if you do that over just one single day, again, anything could happen. So I mentioned there's a strong reversal effect. So 1 day return, a pump yesterday generally leads to a dump today. So most of you probably already know that, and I can prove it statistically. But if you just look at it 1 day at a time, never know. I mean, a coin could pump, a lot of coins can pump multiple days in a row. So you can't just look at it 1 day at a time. So I run that regression not only for today, but I run it yesterday and the day before and the day before, the day before that, and the day before that, and basically, 5 whole years at this point, well over 1,500 days for all coins in existence. So when I'm looking at something like the influence of yesterday's return to today's return, so 1 day, say, pump or dump, to the next day's return, I'm analyzing that over 1,500 plus days. So some days, yeah, a pump yesterday might lead to nothing today or another pump, but generally, on average, we can do even more statistical tests to prove it. On average, yeah, a pump yesterday leads to a dump today, or a dump yesterday leads to a pump today. And we can show that statistically and have those 16 factors that show similar outcomes. So the gist of it is now I have these 16 factors where I'm like, wow, okay, especially there's certain times that these factors lead to outperformance or underperformance for the next day, for the next week. And the gist of the model is, since now I have that information, I know what factors lead to future performance. Well, that's invest in the coins that have a lot of those factors, that have a lot of those characteristics that generally lead to outperformance. Like I mentioned before, anything can happen with any particular coin. This is where your own personal FA or TA could add value. So this is just showing a bucket of coins. Yeah, that bucket of coins should outperform the average coin, and certainly the worst 10% coins. But if you know something weird has just happened with a particular coin, you can disregard the signal. There's nothing wrong with that. In fact, I'd say it's pretty smart. But on average, that's what this is saying. On average, this bucket of say the top 10% that I'll mention quite a bit should outperform the average coin. So hopefully that was a good backdrop. Now I can talk about how I actually use this. So here, you can see Skycoin is at the top, 0 percentile. You can see dark green. So at the very top are the best coins. As I scroll down, the colors get progressively more red. And I basically parsed it out based upon the top 10%, 10 to 25%, 25 to 50%, 50, 75%, 75, 90, and worse than 90. Really no major magic there. And I think it's very important to emphasize that a coin that's 24th percentile versus 26th percentile is basically statistically the same, even though they're different colors here. You need to know they're basically the same thing. So 24 to 26 is a lot closer than 26 to 50, even though they might be the same color here. So keep that in mind. So after I run that model with the 16 factors, and I'm overweighting, I'd like to overweight the coins, or want to own the coins that have more of the factors that have shown to add value in the future. So that's basically all this is, sorted from the coins that have most of those characteristics to the coins that have the least of those characteristics. Kind of simple as that. So what I would like to do, what I do is generally I probably like to own, call it 5 to 10 coins at a time. It varies. And this dark green area over here, I like to to buy generally or own, generally like 3 to 5 at all times. Now, this top 10, this dark green with the white font, those are the best of the best here. So these are the coins that I have the most confidence in, that have the most of those characteristics that have shown that add value. And I'm certainly buying here, and I'm certainly holding here, and I'm never selling here. Now, do I buy all the coins here? Absolutely not. I mean, I look at things like volume, liquidity, exchange. And this, fundamentals too. If I know something weird's going on, like I mentioned before, I'm not going to buy it. But generally, I like to own, say, 3 to 5 in this bucket. Go down to this kind of light green here. This is the 10 to 25. These are still really darn good coins here. So, I have a date wrong from a paste. Don't worry about that. That's still 825. But yeah, these coins, the 10 to 25th percentile, I'll still be more than willing to buy. So if the coins in the top 10, for whatever reason, I don't find any new ones to buy, say I have some capital from a sell, I'll be more than happy to buy in the 10 to 25th range. And I'm definitely holding here. I'm not selling any coins in this range either. It's not worth increasing turnover and fees just to kind of bump up from light green to dark green. Now it gets a little bit trickier here once you get to the 25th to 50th percentile. Remember here, there's a big difference between the 25th versus the 50th percentile. So even though it's the same color, you have to treat them a little bit different. But generally here, I'm actually willing to buy, hold, and sell. Now, for me to buy, it would be kind of tricky. Generally, it would mean that I can't really find any coins above in the darker greens. So it's not that likely that I'll buy here, but it's certainly possible. I wouldn't rule it out. In terms of holding, most of the times I will hold here. It's just, again, it's not probably worth the turnover and the fees. However, if a coin's just not performing, I don't have a good feeling about it, the TA is bad, yeah, certainly I'll sell and I can redeploy the capital here. So definitely not holding through hell or high water here. So definitely able to sell. Go down here. Now I'm below the 50th percentile. That's kind of like a pink. Here, I'm probably never going to buy, but I might hold and I might sell. So the only reason I'd hold here, and at this point, I'll start talking about like urgency of sell. So here, if a coin falls here, yeah, I don't necessarily need to sell right away. I'm not hopping on my computer and pounding a market order. And I can be patient, especially if it's coin I know well, the TA, the FA are fine. I'm not necessarily jumping at the bit. It's okay, especially if I have a lot of capital tied up into other top 10% coins. I'd be okay holding a coin here, especially if it's closer to the 50th percentile. If it's dipping to the 75th, it's a bit more questionable. Now going down to the 75th through the 90th percentile. Now here, it's basically a sell. I mean, the chance of me holding is very, very slim here. So it's almost certain to sell. I'm never going to buy here as well. But the best way I could explain this in terms of urgency, again, I'm probably not running to my computer and pounding the market order, although I'm going to make sure I get it done. Now the bottom 10 percentile, this is exactly where the urgency is high. So this is where I say, honey, I can't eat dinner. I need to go do something. And this is what I do. I blow out all these names. I don't want to be in them. These names are the names that if you consistently hold, you will go bust. And it's been shown that. And I'm happy to show you the performance on why that is. So I do not want to own these for whatever reason. So I kind of sum up some of that over here. Where I have these little X's. The bigger X is kind of the higher confidence, more likely I'll do it. And the smaller X, less likely, but pretty much exactly what I just said. So overall, I'd like to kind of have 5 to 10 coins, spread out primarily through the top 10 and the 10 through 25th percentile. But I'm willing to dip a little bit into the lighter greens and maybe even the pink. So I think now is a great time to jump into performance. I think it's pretty critical to understand, how it's worked and the back test of performance. So, and here we go. So honestly, these numbers are fantastic. If I showed anybody these numbers on the equity side, and I've built quantitative equity portfolios before, they would drop dead. It's, frankly, unbelievable that a quantitative model can tease out such returns. Now, what's very important, now these are obviously back tested. I just built this model over the past month or two, and I have returns here going back to 2015. So what does that actually mean? Now, a bad quantitative analyst, what they would do, they would run their model and say, I finish it today. And they would use the information they know today to influence what they would buy in 2015, 2016, 2017. That's just a fake BS portfolio that wouldn't have existed. So I certainly did not do that. So everything I did here is what they call like as was, or I want to simplify it. Say, imagine you went into a time machine and the only information you knew is that the day you woke up. So this is why, like, I started running the model and getting those regressions and getting that data, back in say 2014, and I think even some in 2013 as well. But I couldn't actually start building a portfolio until I had sufficient data, which was until 2015. So the very first day this model went live in the backtest was June 1st, 2015. So the way to look at it would be you hop in a time machine, you wake up June 1st, 2015, you don't know anything that happened in 2016, 2017, 2018. You only know what happened before June 1st, 2015. And based upon that data, what would you invest in? What would you buy? And that's what this back test and these performance numbers are. And as you can see, they're pretty darn fabulous. So here we're looking at the daily performance. So this means you're rebalancing your portfolio every day. So every day you get my spreadsheet and you do something. And I split it up in terms of those, we call them tiles, but every day you rebalance into the top 10, the dark green, or you rebalance into the 10th to 25th percentile, or you rebalance all your money into the 25th to 50th, or you rebalance it all into the bottom 10%. Do that every single day. And what would your performance be? Well, if you did that every single day, your cumulative performance, and this is over about 38 months now, I don't even know how many decimal points that is, but basically you'd be filthy rich if you invest in the top 10% in the dark greens every day. That's great. And, as a quantitative analyst, that's good information to know, obviously, but what really gets me excited here is how the colors progressively get darker red as we move to the right. So that means as the model is picking up the worst coins, performance is getting a lot worse. And if you notice, if you invest in the bottom 10%, the dark red, you'd be bust. You would have lost everything. If you invested just in the 75th to 90th percentile, you'd be down 85%. So it's definitely picking up both the best coins, the ones that are outperforming, as well as the ones that you really want to stay away from. And then also have like annualized returns. That's just taking the cumulative and adjusting for how many days. I have the volatility here, but I think a lot of you probably want to break it down by years or months. So the top 10 is right here. So this is 2016. It clearly outperformed. It did fantastic. You can see a lot of the greens here. So they're conditionally formatted here. So we want to see a lot of greens in the top 10% column and a lot of reds in the bottom 10% column, which we do. So in 2016, it outperformed with a return of over 1,400%. 2017, obviously bull market, return of over 540,000%. And actually 2018, if you invested in the top 10%, the darkest greens, you'd be up in US dollar terms by 11%. That's pretty fantastic. Considering there's such a terrible market, the average coin is down 82%. So for the top 10% to be up 11% with no stable coins, no tether, nothing like that, 11% is pretty darn good. The bottom 10%, if you did that in 2018, you'd be bust. If you did that in the bull market in 2017, you'd be bust. If you did that in 2016, you'd be bust. So it really doesn't matter. If you're in bull market, bear market, flat market, doesn't matter. If you invest in the worst coins, you'll go bust. And that's why I think diversification is absolutely critical. People saying just buy one coin, they're absolutely insane. Because if you buy the wrong coin, you're done. So you need a methodology to be able to tease out the best coins versus worst coins. And if you can't do that, these average returns over here in column D are actually pretty solid. So I wouldn't necessarily be afraid of that either. So if you want to look at the monthly returns, we don't need to go every month by month, but you could see almost every month here, you're getting a lot of dark greens over here. So the top 10th percentile coins are winning on a month-by-month basis. That's actually what I have over here. So in column M is the top 10 versus bottom 10, just the excess returns. So just subtraction. And column N is the top 10 versus all coins. So I mentioned earlier in this video that the benchmarks were what the model is trying to do, and this is precisely it. So it wants to outperform the bottom 10 in all coins. And green means it outperformed, red means it didn't. As you can see here, there's only one red, and that was back in 2016. Looks like January 2017, where it underperformed all the coins by 20% in 1 month. But other than that, it outperformed tremendously every month. Maybe Donald Trump bigly. So that was certainly fantastic from there. And that consistency is great because you want a model that not only does well in bull markets, but bear markets, flat markets, kind of a no excuses type portfolio, which is pretty important. Now, from a day-to-day standpoint, and we'll get down here. Now, this is what's tricky. So this is why I think it's very important that I own 3 to 5 to 10 coins at a time. So I kind of basket it amongst the highest probability coins, but also, I make sure it's decent on a daily basis or a weekly basis. Because in reality, like I mentioned before, anything can happen on any given day with any particular coin. That's very important to know. So here, you could see in column B of all the days. I think I go back 60 days here. And I publish this every day so you can kind of see how the model's doing. So 100% transparency, not trying to hide anything. I might update the model or something and certainly can talk about it, but that's the only reason why performance might change. So here again, these are the dailies. You can see a heck of a lot more red. On a day-to-day basis, the model doesn't win every day all the time. That is 100% physically impossible. And anybody feeding you anything else is full of it. And anybody that's just kind of feeding you a one coin signal, that's great. And the signal might be great. But at the end of the day, what matters to you is your account balance, is your portfolio growing, not did you win a trade. That the best portfolio managers out there, they hedge. They do things where they're perfectly okay losing a trade as long as they win another trade by a bigger amount and grow their portfolio. So that's what this is trying to do, is grow a portfolio via a holistic strategy. But anyways, you see a lot of reds and greens here, but the point is consistently month by month, they average out to be a positive return. So that's why it's pretty important to at least keep a watchful eye on it. However, here, it makes it seem like I'm emphasizing you need to rebalance on a daily basis. Every single day, put your coins back in the top 10%. And that's not actually true. So the next tab here is weekly holding periods. So what does this actually mean? So this means if you go back to June 1st, 2015, invested in the top 10%. That's great. Well, now you went golfing, you went to a club, you went partying, went on vacation, went to school. Who really cares? It doesn't really matter. You don't do anything for 7 days. And then on June 7th, you pull up your account and you say, okay, now that's rebalance. And then you go party again. Maybe you black out. Who the heck knows? You wake up again in 7 days, June 14th, then you rebalance. So here you're only messing with your portfolio once every 7 days. So a lot less turnover, a lot less fees. And here, we don't necessarily need to go through it line by line, but performance isn't as good. So you definitely lose something by going from weekly from daily. However, the performance is still fantastic. You see the cumulative return here, that's well above what you would if you just invest in the average coin. And then, month by month here, well, here I don't have month by month. So I have 52-week trailing periods, and also 12-week or close to 3-month trailing periods. Basically, again, if you hold for a week, you still do pretty darn well. Your total return is fantastic. You win pretty much every week. Sorry, not every week, every year, and do really darn well every rolling 3 months. But here again, if we go week by week, so I think I have quite a few weeks here again, just like the days on another tab. But you see a lot of red here. So not every week you would win. And that's just the fact of the matter. And again, anyone that feeds anything else is lying. But the point is, it accumulates and it builds. And over time, you end up with a great portfolio that outperforms. So I think that is it for this kind of first round video. So I certainly appreciate you guys jumping in here and hearing my monologue and going through the history of quantitative analysis. And hopefully you understand it a bit better. I think it's also important to know that, I mentioned before, technical analysis dominated, 100 years ago. But these days, it's not as big because we have the data to do quantitative and FA. So we're able to take all the benefits of technical analysis, kind of merge it into quantitative analysis and look at it from a kind of big data statistical standpoint, kind of get best of both worlds. I think also, I didn't mention this, but it's very important. It's quantitative analysis takes out the behavioral problems of technical analysis and fundamental analysis. So, for example, I mentioned, before about a coin with a great 1-week return, but a dump or a pump, yesterday, but maybe they have a MACD, crossover, something going on with the RSI, or who the heck knows, but a bunch of indicators. Well, behaviorally, humans tend to be biased, to anchor, to be overconfident, to be risk averse. So when you have all this information and you're looking at it from a human standpoint, you might be overconfident in yourself and make the wrong call, or you might be biased towards a particular indicator just because you're more experienced with it. None of that is actually going to lead to good investment decisions, frankly. So, with quantitative analysis, now, granted, there's bias in there because I built the model, but from here, there is no bias. It's just a machine. So, the machine's not necessarily overconfident or anchors or has risk aversion or anything like that. So it kind of takes away some of the behavioral bias that can be really detrimental. And we see it a lot in crypto. People just afraid to sell or afraid to buy. Those are all behavioral biases that if you have a disciplined approach via quantitative model that you can mitigate. So I think I'm going to wrap this up. Feel free to ask me any questions, DMs, whatever it is. I think I'm actually going to do another video in a few seconds, kind of go over the results of today's quantitative model and do a cool segment called Love Hate, where I kind of dive into the factors of a few coins, and you can kind of see what's driving the returns, at least driving the expectation of returns. And, obviously, kind of the first round, I don't really expect many viewers right now, but in the future, and I especially do those kind of love hate, kind of update the model, kind of right now segments. I'd love to have some interaction, and we can kind of share some coins, and I can kind of show you what's models thinking for some of your favorite coins. So that'll be on deck. So appreciate your time, and thanks. See you.